Welcome to Financial Revelations, everybody. I am David Safransky, your host, wearing purple today, the color of royalty, of course. You can reach us on Twitter at SkiBucks1. You can call us, 1-800-344-2534. And you can hear us every Thursday morning on WCRF 103.3. Thursday mornings from 8 a.m. to 9 a.m. until they fire me, which will probably be sometime soon. And then you could send questions. If you have a question that you would like us to answer, an individual question about your personal situation, we will either email you back an answer if we have it, or we'll answer it here without giving the details of you personally, because if you have the question, probably other people have the question. And I love to answer listener questions because it tells me that people are paying attention and want to know. In fact, we're going to answer some listener questions today. Before we get to that, current state of affairs, I think it's always important to go over this because the market is very dynamic right now. For instance, in the month of May alone, it's May 23rd as we record, the 2-year Treasury has risen 38 basis points. That is a huge move in the bond market. So the interest rates have come up 1/3% on a 2-year bond. It's just crazy. That's coming out of the banking crisis as things kind of leveled off. Rates returned to normal. Now they're going higher. So rates on the 2-year government bond or less are really all the rage right now. That's what we're talking about. That's what we're buying at we call that the short end of the curve. I'm actually buying a year or less. I'm not even looking at 2 years, but there's going to come a time, I think, relatively soon where we're going to look at those. And we still have an inverted yield curve, which means that the longer the bond, the less return that you get. Well, we don't want that. We want the way the yield curve should work is the longer you have your money at risk, so the longer you go out, 5, 10, 15, 30 years, you should get more interest for that. It's not the case right now because the bond market thinks we're going into a recession, but we've thought we're going into a recession for the last, year. We are starting to see things slow down. It's definitely the Fed is having an effect. So I do think we're going to probably go into some kind of mild recession, some kind of recession. We'll know more as we get closer. Corporate bonds haven't caught up to the U.S. government bond market yet. And by the way, government bonds, U.S. government bonds are considered risk-free. They're backed by the full faith and credit of the federal government. I know we have the debt ceiling. We're going to talk about that a little bit in the quick hit. But the debt ceiling negotiations are coming. They're not. We're not going to default on the debt. I don't even worry about it. So, whatever. There is a Fed meeting June 13th and 14th, and that is really that. And the debt ceiling are the headlines in financial markets. Everywhere you turn, you're going to see something about those two things. We need to raise more. There's no doubt in my mind. I don't know if they're going to do it. I think they are, but everybody else is trying to convince me that they're going to be pausing their rate hikes. And that may happen. I think they're going to raise 25 basis points and then maybe pause. But I think they're in for a hike, and I think that's going to be a surprise to the market. Remember, you could see us on Twitter. All this stuff is scrolling below me, so I don't need to repeat it, but if you need to get in touch with us, it's all right there someplace. Listener questions. Is it wiser to convert a traditional IRA to a Roth IRA? And the answer is, the younger you are, the wiser it is to do that, because really the power of a Roth IRA is in the tax deferral on the growth. So the longer you can keep that money growing tax deferred, the better off you are. That's the power of a Roth. So you have to look at your age. If you're about to go into retirement, it still may make sense, especially if you have a large amount of IRA funds or 401k funds. If you have a 401k and you retire, you can move that to a regular IRA, a traditional IRA, and then you can convert. So we also have to look at the impact that it's going to have on your taxes. So if you're going to convert $1 million of IRA, it's probably not going to make sense to do that all in 1 year. It's the tax bills. You could have a lower tax bill by doing it slowly. And so we have to talk about when you do it. Do you do it early as you can, or later? And how you do it is relatively easy. It's just a form that you fill out. to convert the funds. For most places, like with us, it's a form. We're going to convert that. It is taxable in the year that you do that, and you have to pay the tax. So for a while, when that first happened, you could stretch out the tax over the course of years, but you can't do that anymore. So the younger you are, the more it makes sense. If you had heavy losses in the portfolio, it may make sense. 2020 was a good example. A lot of people converted. Market dropped precipitously. You could convert those shares over to a Roth. Your tax is lower. You keep the shares. They go back up, which is exactly what they did. You kind of won that battle. So I like that idea when there's heavy losses in an IRA. And so the next question is, and I get this a lot, should I take money out of a 401k to pay current bills? And the answer is really, one, I need to get you on a budget. If your bills are out in front of you like that, let's find out why that's happening. Now, it could just be that you had an emergency and you didn't have enough money to cover it. In 2008, people who did the exquisite planning, the Larry Burkett special, they did everything right. They could still lost their house. So it just lasted a long time. We're not in those times right now. So why are your bills getting out in front of you? And I'd also want to know, is there a loan option on that 401k? Because when you loan money from your 401k, you don't actually take it out of the plan. You don't take it out of your account. It is money out of your account, but your investments generally stay in place. And so you could stay invested, pay it back over schedule, you pay yourself back some interest. Okay, that I could almost stomach. I don't like it. It's not my favorite. I don't love it. I'd rather you paying your bills. So we got to get you on a budget. You got to have an emergency fund. These are the pillars of financial planning that we talk about. A budget is number one. You got to have a budget. You got to know what you're spending. You got to know where you're spending it. You got to know why you're spending it. So if you don't have that budget, that's where we really got to start. Now, it doesn't mean we're not going to get through this short term without, we're going to take a loan from the 401k, pay it back over time. But we got to figure out how you got yourself here. Otherwise, you're just going to be back here. And I don't want to do that. I don't like retreading the same ground over and over again, especially when it's rocky ground. Like I can't pay my bills. So, I almost want to say we got to figure out a way for you to scrape your face on some broken glass and make ends meet. We gotta make this work with what you got. We got to make it work, and maybe it's not possible. So maybe we got to find a way to add some income into the mix. So let's figure that out, and then take the next steps. Now, very popular today. The last question that we have is this is all about retirement planning. So today, what about a Roth 401k versus a regular 401k? You know what? In a regular 401k, you put your money in, it goes in pre-tax, so it doesn't hit your W-2 or anything like that. And then it's in there for a number of years growing, and you're going to pick a great portfolio and all that, hopefully. And then when it comes out, every single dollar is taxable. Well, when you look at our federal government right now, it doesn't matter who's in power. The debt is going up and up and up and up. How do you think we're going to pay for that? What do you think is going to happen? They're going to have to raise taxes. At some point, they're going to have to raise taxes. I don't know how, we're going to start with the rich people because they're easy. If you go to the 1%, well, that's only 1%. 1% can't vote you out of office. And depending on, if you're a Democrat, you like to punish rich people, so you're going to do some of that. But Republicans spend a lot of money too. They love to talk about spending when they're not in charge, but when they're in charge, they realize how they get voted back in. So if you are young, if you're just starting out and they offer you the Roth 401k option, I think you should pick that because the money is taxed. It goes in after tax to a Roth 401k, but it grows tax-free and it comes out tax-free. And, the rule of 72 is that if you take the number 72 and you divide it by the interest rate that you think you're going to get, let's say 8%. So every 9 years, your money will double in there at 8%. And that's money that you've never paid taxes on and you're never going to pay tax on in a Roth 401k. So I like that. Now, what if you're 50 and they offer the Roth 401k. Well, if you've been contributing to the regular 401k the whole time, I would make a clean break. I would keep that regular 401k there, and I would start the Roth 401k. I would definitely do it. It is so worth it because I know that 10 years from now, given the right set of circumstances, if we don't cut spending, and we're going to have to cut spending, we're going to be raising taxes. And so that makes your 401k, your traditional IRA, worth less because tax rates are going to be higher. And, let's say that you're living on $100,000 a year and you want to maintain that standard of living. Well, when you leave work, there's some work expenses that stop, but there's some retirement expenses that begin. So it's not just like, oh, it's going to automatically cost me less. And you might want to travel and add some retirement expenses in there. So you might need to live right around that income to maintain your standard of living. If that's the case, your taxes are going up. If you're in a Roth 401k, your taxes are going down. And I like that. So the less tax we have to pay. Now, I love America. I travel all over the world, but when I come back here, I realize how fortunate we are. So I'm not saying cheat on your taxes or anything like that, but I don't want you to pay a cent more than what you have to pay. Make them figure out a way to spend less. We're like cradle to gravers now. We're going to pay for everything forever for everyone, even if you're not a citizen. I mean, look at the southern border right now, what's happening. It's basically anarchy. And so, and I understand that immigrants are coming here for a better life. I get that. And we want to welcome immigrants here. We're a nation of immigrants. We're built on immigration. We should never stop that, but people need to come here legally. That's all we're asking. We'll let a lot of people in, but you got to come here legally. We need to know who you are and where you're from. And a lot of people will say, well, we don't know anything about these people. Well, if you live in Guatemala, my guess is that the record keeping isn't great. But if you got a big MS-13 tattoo on your face, it's all the records we need. Nobody's going to do that just to fit in. They're going to do that because they're in a gang. We got enough felons here. We don't need to import them. So remember, email us, call us, listen to us on WCRF. We love that place. Email Corey. Corey loves reading your emails. I have it on good authority. She loves you. The crazier the email, the more she loves it, by the way. So ask her crazy questions. She loves that stuff. I am David Safransky, a real American, a true red-blooded patriot, and the voice you could trust.